In today's news, Donald Trump, Tom Lee and the SEC, they have all just sounded the alarm. The warning that the next substantial leg up rally is almost upon us. With a stagnating economy but decreasing interest rates, the Federal Reserve will be forced to step in sooner rather than later or risk a crisis of similar magnitude to the 2008 financial crash. And with regulations closer than ever before soon to be enforced in America, the moment we have been praying and waiting for is almost upon us. And if you don't want to miss out on the incoming opportunities, then come learn more here in the VIP, wap.com/coin factory. From alpha institutional research documents, learning what these institutions are saying to their clients, allowing us to get ahead of the retail market, educational courses, trade alerts, and so much more. Check it all out for 7 days free, link down below in the description, and I hope to see you there. So to start off with, we have a very recent post here from Donald Trump, where he is once again acting very frustrated and hostile towards the federal chairman Jerome Powell, stating that the ADP number is out and Powell must lower the rate. Europe has lowered them 9 times. He is unbelievable and always too late. As we can see here on forexfactory.com, the ADP non-farm employment change, the number, is a measurement of how private sector jobs, how many were created in May last month. And the report showcases that there were 60,000 that's created in the month before in April, a projected increase of 111,000 jobs for May, but in actuality, only 37,000 jobs were created in the private sector. That is almost half of what we saw last month and 3 times less than was expected for this month, which is extremely concerning. We are no longer heading towards stagflation or a stagnating economy, we are already in it. Now, while inflation isn't as low as the Fed want it to be, all inflation metrics have come back month on month either as expected or lower than expectations, which is good. Lower than expected inflation with a stagnating job market and economy, that is the perfect recipe for rate cuts and quantitative easing. The bottom line is, as explained in this video here from Professor St. Onge, the Fed are going to have to step in and start issuing quantitative easing, printing money, or risk back-to-back quarters of negative GDP, meaning recession confirmations. And if we get those confirmations, we will see a crisis of similar magnitude, if not worse than the 2008 financial crash. Listen very closely.
Last week, 2 influential mainstreamers, Ray Dalio and Jamie Dimon, warned a financial crisis is coming. Now that federal deficits are projected at nearly $3 trillion per year for the next decade, courtesy of Republicans in Congress. For perspective, before COVID, $1 trillion was a crazy number on the deficit. Before the 2008 crisis, it was $500 billion that got the headlines under W. We thought that was bad. The first warning came from Dalio, founder of the world's largest hedge fund, Bridgewater. He warned of a, quote, breakdown in bond markets as roughly $10 trillion of federal debt looks for buyers this year. When there's not enough buyers, it drives down bond prices, which automatically drives up interest rates and incidentally crashes banks, which we saw in 2023. When interest rates rose thanks to the Fed. Now that all drives up the cost of borrowing in the entire economy, strangling businesses and driving up mortgages, credit cards, and car loans, which squeezes consumers and historically leads to recessions. And the only way to head that off is for the Fed to jump in and, quote, print money. As in, the Fed fires up their basement computers, types a bunch of zeros on an Excel sheet, and uses those counterfeit dollars to buy trillions of dollars in bonds. The official term for this is quantitative easing, which sounds better than counterfeiting. So in short, either they let rates cause a recession or they let inflation rip. The solution, of course, is don't pump out so much debt into bond markets. That's currently overwhelmingly a government thing. Roughly 80% of debt issuance in the entire American economy is the federal government. The rest of us make do with crumbs.
So the Fed, evidently, they are still playing politics. The wait and see approach, Seemingly, they are still worried about what tariffs will do to the economy, but they are very, very quickly running out of room and time. And as Tom Lee explained on CNBC just earlier as well, very bullish confirmation that we need to prepare for a melt-up rally. We are now at a huge risk of missing out, a FOMO run, and the next substantial leg up is extremely close. Again, listen closely.
Yeah, you'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. In our calls and Zooms with portfolio managers, many are still cautious because they see tariff risks ahead and they don't have tariff resolution in hand and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
What role do tariffs play in all of the way you're thinking about the market?
Well, tariffs matter. Remember, before February, before Trump sort of talked about this, the base case for many was a 15% tariff. Let's say that we're going to end up at a 10%. That's 10% on 15%, which is imports, which is about a 1% GDP effect. That's not that different than oil going from 40 to 80, and we wouldn't say $80 oil breaks the economy anymore. So I think tariffs aren't, we have to adjust to it, but it's not the thing that takes us to 4,000 S&P anymore.
Now, what if there's a renewed and more protracted, if not dug-in fight over the tax bill? What if Musk's post on social media earlier is enough to get some lawmakers in a very thin margin Washington to rethink their positions based on his political donations or lack of support in the future? Is that a real concern in any way?
Well, this is what's going to be set up as what I'd call event risk. And it's an event risk similar to a government shutdown or an auto plant shutdown, something that affects the economy for a specific period of time. But again, those have not been things to turn structurally bearish. They may be tactical risks, but again, they've always been buy the dip opportunities.
The fact that we are also just 2 weeks away from the first of many crypto regulatory frameworks being enforced in America is also going to act as another massive piece of this puzzle to increase FOMO and to send this next leg up for crypto even higher. The Genius Stablecoin Act will be the step needed to save the dollar, according to Donald Trump Jr., save America, giving dollar-backed stablecoins more volume, more adoption, more use case. That will send XRP's use case higher as well, demand and price a lot higher because of RLUSD. The market of stablecoins is one that's going to be so critically important for crypto projects and America as well, with stablecoins market cap approaching $250 billion and potentially reaching $2 trillion soon. Conflicts could have significant implications for Treasury financing. Some of the recent amendments to this bill, because there's been a lot of back and forth going on between Republicans and Democrats, some of the amendments include allowing the Treasury Secretary to grant, quote, safe harbor exceptions to permit otherwise unqualified stablecoin issuers, including under unusual and exigent circumstances. After countless hours of hard work and negotiations, the Genius Act is almost through the Senate, and this could likely spark the next move for crypto. And if this aligns with the Fed's timeline to hopefully step in soon and cut rates, as again the economy is in dire need for them to do it to avoid a recession, then of course we're going to soar so much higher very, very soon. Remember as well, Jerome Powell, despite him and Trump don't see eye to eye, he does agree actually that the stablecoin bill is a necessity and a very, very good idea. So it's going to come through. It's only a matter of time, and this is only going to further elevate XRP status going forward, as they are making significant developments and partnerships literally every day at this point. Yesterday we saw DZ Bank going live at XRP Ledger and Dubai officially recognizing the RLUSD stablecoin. And now, today, we have received confirmation the Chinese firm Weebus files with the SEC to raise $300 million for an XRP Treasury plan and Ripple payments integration. That's huge. SEC, Tom Lee, Trump, all are indicating that time is running out. Fed to step in, and the next leg of this bull run for crypto for XRP is imminent. Institutions are getting involved more and more. It's only a matter of time. Slow and then sudden. The floodgates for XRP, all the institutional partnerships are coming forward. They are about to open. And that's because the XRP ledger has promised to be a cornerstone of the internet of value, not just a crypto, a scalable, efficient, modern model for the entire financial ecosystem. Do your own research, of course, not financial advice. Or better still, if you want to learn a lot more to get ahead of the game, come check out the VIP. And as always, don't look short term, think long term. And I'll see you in the next one.